You know, there are moments in financial history where a single policy decision creates ripples that transform an entire market overnight. We're living through one of those moments right now, and if you're not paying attention, you're going to miss the biggest structural shift in precious metals trading in decades. It's January 23rd, 2026, and what started as a geopolitical headline about Greenland has morphed into a full-blown crisis for the global silver infrastructure. While the cable news networks are obsessing over diplomatic tensions and the optics of land acquisition proposals, the real story is unfolding in the back offices of major bullion banks, where risk managers are frantically recalculating their entire operational frameworks. Welcome to Finance Folder, and if you want to understand what's really happening in the silver market right now, you need to hit that subscribe button because we're about to break down a market event that most analysts are completely missing. Let me set the stage for you. On Sunday, January 18th, President Trump announced a trade policy that, on the surface, appears to be about pressuring Denmark into negotiations over Greenland. The policy includes a 10% tariff on imports from 8 European nations, including the United Kingdom, effective February 1st. If negotiations don't progress, that tariff escalates to 25% by June 1st. Now, to the casual observer scrolling through their newsfeed, this looks like typical trade war posturing. Politicians make dramatic announcements, markets react briefly, and life goes on. But here's what separates sophisticated analysis from surface-level commentary. When you understand the plumbing of the global silver market, you realize this tariff doesn't just create friction, it fundamentally breaks the mechanism that has kept silver prices suppressed for years. The entire global silver market operates on a principle that most investors take for granted: the concept of fungibility and seamless geographic arbitrage. A 1,000-ounce bar of silver stored in a London vault is supposed to be functionally identical to a 1,000-ounce bar stored in New York. More critically, the system depends on the ability to move metal between these locations quickly and cheaply to balance supply and demand imbalances. The major bullion banks have perfected what traders internally call the geographic rebalancing strategy. When physical demand surges in New York and threatens to push spot prices higher, banks pull silver from London vaults, specifically from LBMA facilities, and airlift it across the Atlantic to flood the New York market and cap the rally. Conversely, when London inventories drop too low because of relentless physical offtake to Asia, particularly India and China, the banks execute the reverse operation, draining COMEX-approved warehouses in New York and shipping that metal to London to replenish depleted stocks. This constant back-and-forth flow of physical metal across the ocean is the operational backbone of price management in silver. It creates the illusion of abundant supply because the same pool of metal can be shuttled to whichever market is experiencing stress. The system works beautifully as long as moving metal between jurisdictions remains economically neutral. But Trump's tariff announcement just threw a massive wrench into this carefully calibrated machine. The United Kingdom is explicitly on the tariff list, and the LBMA, the center of global physical silver trading, is located in London. Starting February 1st, any silver that a U.S. bank ships to London and then attempts to bring back to the United States will be subject to a 10% import tax on the value of the metal. At current prices, around $90 per ounce, that's a $9 tax per ounce. In the razor-thin margin world of bullion banking, where profits are measured in basis points, a 10% haircut on metal movement is not just a cost, it's a complete destruction of the business model. What Trump has effectively done, whether intentionally or accidentally, is transform the U.S. border into a one-way valve for silver. Metal can potentially flow into the United States from non-tariff countries, but metal cannot economically flow out to London, because once it crosses that border, the cost of bringing it back wipes out any conceivable trading profit. This creates what commodity traders call a trapped inventory scenario. Right now, risk managers at every major bullion bank are staring at this policy announcement and issuing internal directives to freeze all silver exports. They cannot afford to ship metal to London if there's any chance they'll need that metal back in the US in the coming weeks or months. The tariff makes the round-trip transaction financially suicidal. This decision, made in boardrooms across New York this past weekend, effectively severs the physical connection between the COMEX and the LBMA, the two largest silver pricing hubs on the planet. And the timing of this policy couldn't be worse for London. Based on publicly available vault data and analysis of LBMA inventory reports, London has been experiencing a slow-motion drain of physical silver for the past several years. The relentless demand from India for jewelry and industrial applications, combined with China's strategic accumulation, has pulled massive quantities of metal out of London vaults and sent it east. The float of available, unencumbered silver in London, meaning metal that isn't already pledged to ETFs or other commitments, has dropped to levels that make seasoned traders nervous. London has been surviving on the assumption that when push comes to shove, they can call New York and have millions of ounces airlifted across the Atlantic within days. That assumption just evaporated. The cavalry that London was counting on is not coming. The silver that would have flown from New York to bail out tight supply conditions in London is now grounded in American warehouses. This transforms the equation completely. There was significant attention in precious metal circles on Friday when over 4 million ounces of silver were withdrawn from COMEX-approved warehouses. At the time, many analysts assumed this metal was being prepared for export, likely destined for London or Asian markets. But with Sunday's tariff announcement, the calculus has completely changed. That metal is almost certainly stuck in the United States now. The entity that withdrew those 4 million ounces is facing a choice. They can ship it to London and accept that they'll never be able to bring it back economically, or they can hold it in the US and sell it to domestic buyers. Given the uncertainty and the financial penalty built into the tariff structure, the rational decision is to keep the metal stateside. This means the physical shortage that London is experiencing is about to accelerate dramatically, while the US market paradoxically might see a slight easing of immediate tightness, because metal that would have left the country is now staying put. But here's where it gets really interesting from a market structure perspective. This tariff introduces what's called basis risk into the silver market at a scale we've never seen before. Basis risk is the nightmare scenario for any trader running a hedged book. In normal times, if a bank is long physical silver in London and short silver futures in New York, those positions offset each other because the underlying commodity is the same and can be moved between locations to close out positions. The hedge works because geographic arbitrage is possible. But when you put a 10% tariff wall in the middle of the Atlantic Ocean, that hedge breaks down. If the price of silver in London spikes to $110 while New York stays at $90, a bank that's long London and short New York is now bleeding money on the spread. And they can't fix it by simply moving metal because the tariff makes that uneconomical. This forces banks to unwind their positions, to close out their shorts in New York and liquidate their longs in London. And when multiple banks are doing this simultaneously, it creates buying pressure in the New York market even as London is selling. The broader implication here is market segmentation. We're about to enter a period where the concept of a single global spot price for silver becomes meaningless. You could very realistically see silver trading at $90 in New York, $110 in London, and $115 in Shanghai, all at the same time. And those price differentials will persist because the arbitrage mechanism that normally closes those gaps has been disabled by policy. The law of one price, a fundamental principle in commodity markets, has just been suspended by executive order. For investors trying to navigate this environment, this creates both opportunity and confusion. Which price is the real price? The answer is the price in the market where you can actually take physical delivery. Paper prices become increasingly irrelevant when the physical metal can't flow to where demand is highest. Now let's talk about the second order effects that most people aren't considering yet. Many of the refiners that supply silver to the US market are located in Europe and Canada. If this tariff applies broadly to silver products from these nations, then imported refined silver just became 10% more expensive overnight. This raises the replacement cost for every dealer in the United States. When companies like APMEX or SD Bullion need to restock their inventory, and if their suppliers are in tariff-affected countries, they now have to pay 10% more for the same metal. That cost doesn't disappear, it gets passed directly to retail customers. So even if the spot price on the screen says $90, the actual street price for physical silver in the US is going to climb higher. The tariff effectively puts a floor under premiums. It bakes inflation into the physical product. This validates what many dealers have been experiencing already, which is premiums that seem disconnected from spot prices. The tariff just made that disconnect structural rather than temporary. There's also a strategic dimension to this that's worth exploring. By making it financially toxic to export silver from the United States, this policy inadvertently creates a domestic strategic reserve. We've heard a lot of discussion over the past few years about the need to secure critical mineral supply chains for national security purposes. Silver is used in everything from solar panels to defense electronics to EVs. The US Mint has faced periodic shortages of silver blanks for producing coins. Well, this tariff solves that problem by accident. If banks can't export silver to London without taking a massive financial hit, that silver stays in the United States. It remains available for Tesla's manufacturing needs, for Raytheon's defense contracts, for the US Mint's production runs. It forces the ghost supply, the metal sitting in warehouses that might have been shipped overseas, to remain within American borders. Whether this was the intended effect or not, the outcome is the same. It's resource nationalism applied to precious metals. Now let's shift our focus across the Atlantic to understand what this means for London specifically. The London Bullion Market Association is the epicenter of physical precious metals trading globally. While COMEX in New York is primarily a futures market where most contracts are settled in cash, London is where the large physical transactions actually occur. For the past 3 years, London has been hemorrhaging silver inventory. The vault data shows a steady exodus of metal flowing to India and China. The amount of silver in London vaults that's genuinely available, meaning not already allocated to ETF holdings or other commitments, has dropped to what many analysts consider critically low levels. London has been operating on borrowed time, sustained only by the knowledge that if things got too tight, they could call New York and have millions of ounces shipped over within a week. That safety net is gone. Starting February 1st, no rational bank is going to ship silver from New York to London because the economics of bringing it back are prohibitive. London is now effectively cut off from the Western Hemisphere's silver supply. They're an island, both geographically and now financially, and they're still facing the same relentless demand from Asian buyers. This creates a siege mentality. When trading opens on Monday morning in London, the professionals in that market are going to wake up to the realization that their access to backup supply has been severed. They've sold more silver than they have physical access to, and the reinforcements aren't coming. This is the textbook setup for a localized default scenario. We could very realistically see a situation where the London silver price completely disconnects from New York. Imagine silver trading at $90 in the US, while simultaneously trading at $110 or even $120 in London. Why would such a price gap persist? Because in London, the metal is genuinely scarce, and because the tariff prevents arbitrage traders from buying cheap in New York and selling expensive in London, the price differential becomes sticky. It doesn't get arbitraged away like it normally would. This kills the concept of a unified global spot price. If you have 3 different prices in 3 different markets, which one is real? The answer is all of them, because each price reflects the local supply and demand dynamics in a world where metal can no longer flow freely. This bifurcation creates chaos for the banks because it destroys their risk management models. Most major banks run global books. They might be long silver in London and short in New York, with the positions designed to offset each other. In a normal world, this is a hedged position, but if London's price rockets higher while New York stays flat, that hedge explodes. They start losing massive amounts of money on the spread between the two markets. This forces them to frantically close positions, buying back their New York shorts and dumping their London longs. The result is buying pressure in New York and selling pressure in London, which ironically could widen the spread even further before it eventually stabilizes. There's also the issue of unallocated accounts in London. Millions of investors around the world hold unallocated silver with LBMA member banks. This is essentially fractional reserve banking applied to precious metals. You own a claim on silver, but the bank doesn't have a specific bar set aside with your name on it. The bank operates on the assumption that not everyone will ask for physical delivery at the same time. But what happens when London gets cut off from supply and investors start getting nervous? You get a run on the bank. Investors rush to convert their unallocated claims into allocated bars, demanding physical metal. But there aren't enough bars to go around because the vaults are depleted and new supply can't arrive from New York. This forces banks to go into the open market and bid aggressively for any available metal, which drives the price even higher. A liquidity crisis morphs into a solvency crisis. The Greenland Tariff, a policy nominally about geopolitics, has exposed the fragility of the entire global silver infrastructure. Let's talk about what happens to that 4.2 million ounces that was withdrawn from COMEX warehouses on Friday. Before the tariff announcement, the assumption was that metal was leaving the country, probably heading to London or Asia. But now, with a 10% tax making export uneconomical, that metal is almost certainly stuck in the United States. The owner of that silver is sitting on a massive pile in a warehouse, probably near a major airport, trying to figure out what to do. They can't ship it to London without accepting a permanent 10% loss on any future reimport. So what are their options? They hold it, waiting to see how the situation develops. Or they sell it to a domestic buyer, someone who needs physical silver in the United States, like an industrial manufacturer or a large investor. Either way, that metal isn't leaving the country. This implies that domestic supply in the US might actually stabilize in the short term, but at a much higher price point because replacement costs have jumped. The other thing to consider is how this affects the suppression tactics that banks have allegedly used for years to keep silver prices contained. The ability to suppress price requires having flexibility, having access to large pools of metal that can be moved quickly to wherever a price spike is developing. You need to be able to flood a market with supply at a moment's notice to cap a rally. But when tariffs lock metal into specific geographic locations, that flexibility disappears. A bank can't suppress the London price by threatening to ship metal from New York if that shipment would cost them 10% to reverse later. The tools they've relied on to manage price volatility are being taken away. As banks face risks they can't quantify and can't hedge, they reduce their exposure. They stop writing as many short contracts. The artificial ceiling on silver prices starts to crack. We're also seeing the beginning of a broader trend that's going to define commodity markets for the next decade, the return of resource nationalism. For the past 30 years, we've operated in a globalized world where capital and commodities flowed relatively freely across borders. Trade barriers were low, logistics were efficient, and markets were integrated. That era is ending. We're entering a world where countries and economic blocs are increasingly prioritizing control over strategic resources. Every nation is starting to ask the same question. Do we have enough of the critical materials we need, and if not, how do we secure them? Tariffs, export restrictions, and strategic stockpiling are becoming the new normal. In this environment, owning physical assets in your own jurisdiction becomes exponentially more valuable than owning paper claims on assets stored somewhere else. For individual investors, this creates a fundamental shift in how you should think about precious metal strategy. The old model of just watching the spot price and buying when it dips is becoming obsolete. In a fragmented market, the spot price you see on financial websites is increasingly meaningless. It's an average of multiple broken markets, a mathematical fiction. What matters now is replacement cost. If you sold your silver today, what would it actually cost you to buy it back? What premium would you have to pay? That's the real value of your stack, not some abstract spot price calculated from futures contracts that most participants never intend to settle physically. Geographic diversification, once considered smart practice, is now potentially a liability. In a world of trade wars and tariffs, having metals spread across multiple countries means you might not be able to access it when you need it. The safest place for your silver is where you are, in your possession, or at least in your jurisdiction. The long-term trajectory here is clear. We're watching the unraveling of the integrated global silver market. What's replacing it is a collection of regional markets with different prices, different liquidity conditions, and different access to supply. The banks that have managed this market for decades are losing control because the logistical infrastructure they depended on is breaking down. Tariffs are just the beginning. As supply chains continue to fragment and geopolitical tensions escalate, the barriers to moving physical metal are only going to increase. This means volatility, price dislocations, and periodic shortages in specific markets. It also means that anyone holding physical silver in a secure jurisdiction is holding an increasingly strategic asset. As we head into this week, expect confusion. Expect contradictory signals. The spot price might not move dramatically at first because the futures markets are still operating on old assumptions. But underneath the surface, the physical market is convulsing. Contracts that traders thought were hedged are no longer hedged. Supply lines that banks counted on are severed. Prices in different markets are diverging. The professionals who manage risk for major institutions are scrambling to recalculate their exposures. Some of them are going to get it wrong, and when they do, we'll see blowups. We'll see forced liquidations, margin calls, and potentially defaults. The market is entering uncharted territory. The verdict for anyone holding physical silver is straightforward. Your position just got stronger. The tariff trap, whether intentional or accidental, has locked supply inside the United States. The government has inadvertently created conditions that favor physical holders over paper traders. The floor under prices is solid because replacement costs have jumped. The ceiling that kept prices suppressed is cracking because the tools used to manage rallies no longer work efficiently. The smart play is to hold your position and not get shaken out by short-term volatility. Eventually, prices will settle at levels that reflect the new reality of fragmented markets and restricted supply flows. That level is substantially higher than where we are today. Thank you for watching Finance Folder. If you found this analysis valuable, make sure to subscribe to the channel and hit that like button because we're going to be tracking this situation closely as it develops. The week ahead is going to be historic. We're watching the architecture of the global silver market fracture in real time. The mainstream media is focused on the political theater, but you now understand the real story. The logistics have broken, the pricing mechanisms are failing, and physical metal in your possession is the only thing that's truly secure. Stay focused on the physical reality, not the paper illusion. We'll see you in the next video.